Welcome to the Luca Ledger.
Welcome back to the Luca Ledger with Brett C. Arnold, CPA and president of Luca Financial. Brett works with entrepreneurs and small business owners to help them understand their numbers, reduce unnecessary tax burdens, improve cash flow, and build more profitable businesses through strategic financial planning and fractional CFO guidance. I'm Evan Mack, and today we're talking about one of the most misunderstood parts of running a business, how owners actually pay themselves, the difference between salary and owner's draws, and why getting it wrong can create financial and tax problems later. Brett, welcome back, brother.
Hey, thanks, Evan. I appreciate it. I think this one will be a really crucial episode for business owners.
Yeah, this is going to be a good one. So, Brett, like paying yourself sounds simple on the surface, but a lot of these business owners are unclear on how it's actually supposed to work. Why does this become such a common issue?
Yeah, it does sound really simple, but like you mentioned, it's probably one of the most common questions we get from clients, especially new clients. I've set up this business. How do I get money out? If I take it out, am I taxed on it? If I don't take it out, am I taxed on it? So we get a lot of questions there. I think it's because there's a lot of different types of business structures you can set up, and those types dictate how you're going to go pay yourselves. And there can be compliance issues. If you pay yourself the wrong way, you can get penalized and you'll pay underpayment fines, you'll pay extra tax, there's errors, or maybe you're not paying yourself at all. Again, depending on the entity structure, there's penalties and fines and additional tax. So I think that's where a little bit of the hesitation comes from business owners is I've heard all these types of ways I should pay myself. What's the best way? And it really depends on the way your business is set up from the beginning.
What's the difference between taking a salary and taking an owner's draw?
Yeah, so really important question and really important distinction. Whenever we use the term salary, we're specifically talking about a W-2, a payroll paycheck with taxes withheld that is coming your way. So just like if you were to go be hired and employed by another organization receiving a paycheck, that is your salary. Same thing if you own a business, again, depending on the type of entity, and we'll get into that in a little later in the episode. Depending on the type of entity, you need to take a salary. Again, that's when taxes are being withheld. You're getting paid every 2 weeks, once a month, whatever it might be. Versus owner's distribution or an owner's draw, it's kind of the same concept there. That's when you're simply just taking money out of a business bank account and depositing it into your personal bank account. Two very different things. They've got different tax implications depending on the entity setup that you've got. But the distinction there is salary is a W-2 that is reported to the Social Security Administration that's having taxes withheld. Draw or distribution is simply a transfer, a withdrawal. You're writing a check from a business account to a personal account.
How does the structure of a business affect the way an owner pays themselves?
Yeah, so very important here. So a lot of times, new businesses set up an LLC. Most of the time, sometimes you do business as a sole proprietor under your social security number, or you get an EIN associated with your name. But most of the time, we've got an LLC set up. An LLC is formed, or a limited liability company is formed at the state level. So every state has their different way to set up an LLC, but it's a state designation. Whenever you set up an LLC, all that does is it provides a little bit of liability coverage between you, the business owner, and you, the individual. It separates those assets when you start to put things into an LLC versus you owning them with your, let's say, social security number. So in the eyes of the IRS, when you have an LLC, it's almost treated as the same thing as you not having an LLC in terms of taxability. So it's called a disregarded entity. You don't file a separate tax return. It's just another form on your individual tax return when you have an LLC, assuming we've got one member. When you have an LLC, you should not pay yourself a salary. If you pay yourself a W-2 payroll from an LLC that has not incorporated, then you're out of compliance. Reason being is any earnings that come into an LLC that are not taxed differently are subject to self-employment taxes, and all of those earnings are subject to self-employment taxes. So you're out of compliance if you go pay yourself a salary. You just take owner's draws. However, everyone hears of S-corps, the magic S-corporation. If you were to go tell the IRS, I have this LLC that I set up in the state of Texas or whatever state it might be, but hey, Mr. IRS, I want you to treat me as a small business corporation or an S corporation. And that's a designation that the IRS allows business owners to make to say, hey, we're going to treat you this way. If we treat you that way, though, because there's some tax benefits there, if we treat you that way, we need ours as you get yours. So we need you to put yourself on a payroll. That is one of the compliance requirements from an S corporation standpoint. So whenever you do establish your LLC as an S corporation, you have to pay yourself a salary. So you'll pay yourself a wage, you'll withhold Social Security, Medicare, a W-2 goes to the Social Security Administration, payroll reports go to the IRS, and then you can also take draws. But that's an important distinction between the two. And there's also a lot of tax benefits depending on how you set it up as well.
So Brett, what are some of the biggest misconceptions business owners have about paying themselves properly?
So a lot of times I see owners, especially in LLCs, single member LLCs or partnership LLCs who have not incorporated, paying themselves a salary because they think, hey, I've done some research and I think that if I were to go hire myself, I would pay somebody about $75,000 a year. So I'm going to set myself up on payroll. Again, that's non-compliant, and that is cause for penalties and fines from the IRS if you do that. So a pretty big misconception there. And then another really big misconception I get is if I take money out of my business bank account, I'm going to pay taxes on it. That is categorically false. When you earn the money is when you have to pay taxes. The IRS doesn't care what bank account it sits in. So when it was earned is when you have the liability to pay the tax. So an example I always like to share, if I've got a business who, let's say they had $200,000 of income, we're going to go with the year 2025. They had $200,000 of income in 2025. They had $100,000 of expenses, let's say rent expense, marketing, software, maybe they had a contractor. So they made $100,000 at the end of that year. Income 200, expense 100. I made $100,000 in that year. They left it all in their business bank account. They didn't take any of it out. They didn't have an owner's draw. Let's say they were an LLC, they're not an S corp, so they didn't have payroll. They left it all in their business bank account because they're under this misguided conception that if I don't take it out of my business account, I don't have to pay taxes. So then we go to file the tax return. And I say, hey, it looks like on company ABC, you made $100,000. You need to send a check to the IRS for $27,000 or whatever the tax might be. And then they'll say, but I didn't take it out of my business. And that's when I say, but the concept is when it was earned is when the tax is due. So fine, great, Brett, I'll send my check to the IRS. So they pay their taxes. So now we're in the year 2026. 2026, hard year, I made no money. I had no income, I had no expenses, but I still had that $100,000 in my business bank account. I needed it, so I took it out of my business bank account in 2026. Well, at the end of the year, you don't pay any tax on that money, even though you took it out of your business bank account and put it into your personal account, because you pay taxes on it when it was earned last year. So that's a really important misconception that a lot of clients make, is that if I leave it in my bank account, I don't have to pay taxes on it. And if I take it out of my bank account, I do have to pay taxes on it. It's just not how it works.
How important is it to separate that personal spending from the business finances, especially as you continue to grow as a business?
Yeah, this is huge. So it's of the utmost importance as a business owner that you are not using your business accounts for personal expenses. You set up that LLC for a reason. It's a limited liability corporation because it gives you liability and separation between your business and your personal. But the minute you start to commingle those expenses, they call it piercing the corporate veil. You've pierced that veil. There's no longer a separation between business and personal anymore. So that liability, that limited liability coverage kind of goes away because now I'm commingling things. So I had on our Q1 2026 webinar, we had Colleen McKnight on our call. She's a business attorney out of Houston. And we talked about this topic in particular. And she reiterated the importance of keeping those things separate. So anytime we start talking to new entrepreneurs, I say, you go get yourself a business credit card and you only use that for business expenses. I keep two cards in my wallet. I've got a business credit card and a personal credit card. I use my personal credit card for anything personal and my business for anything business. And that way I'm not mixing those expenses. And that's really important. Colleen mentioned if you were to ever get into some sort of litigation or a lawsuit or any IRS trouble, and they look through your records and they're seeing commingling of those expenses, that's when you could really find yourself in a lot of trouble because, again, that coverage that you get by setting up the LLC kind of dissolves.
Mm. So with that being said, what should business owners think about when deciding how much money to leave inside that business versus paying themselves, more personally?
Yeah, so big question here. And a lot of times we tell business owners, so there's kind of a common idea among the entrepreneur world that you want to keep 3 to 6 months of expenses in cash reserves in your business bank account. It's a smart idea. And like we talked about on our last episode, talking about cash crunches, this is an important tool to help you kind of weather some of those tough times, keeping that money in there. But then we've also told our clients, but you don't want to keep everything in your LLC because again, when you set up an LLC, that gives you that limited liability coverage. So if you had a disgruntled client and they were to go file a lawsuit against that LLC, the assets in the LLC are what are at risk. So if I'm just keeping all of my life savings in my business and not taking it out, that's at risk. So cash flow planning is a really important tool here, but as a business owner, you can decide what's this kind of like comfort level of cash that I want to keep in my business. And then I've earned all this other cash. I'm going to take it out and go put it into my personal portfolio and buy assets with it or put it into a savings account or live my life with it, that sort of thing. So big decisions there. The two biggest are kind of a cash flow and then a liability standpoint as well.
Mm. So how can the way an owner pays himself impact the taxes, in the cash flow or that long-term business stability?
Yeah, so taxes can be a really huge impact on an owner pay. That's why a lot of times you hear a lot of stories about S corporations and why they're important, and they save people a lot of money. So just by let's say I've got a business owner making $100,000 a year, by telling the IRS they would like to be treated as an S corporation, their tax bill goes from let's say close to $30,000 down to about $15,000. Again, there's a lot of variables at play there, but just making a simple S corp election can save you about $15,000 in a year at minimum. So it's a really important election to make. And whenever you make that election, again, you've got to be compliant and start paying yourself a salary. So there's some tax impact on how you've got your business structured. It's not for everybody. We'd want to review your situation to say, here's what makes sense for you when we're looking at tax numbers. But that's an important distinction to make, I say, whenever we're talking about taxability. Cash flow wise, I think cash flow is very important in any way your business is structured because when I was giving the examples earlier of looking at our cash flow, and I think on the last episode we talked about this as well, managing the expectation of where your cash is going is important. So I like my business owners to set up a consistent owner's distribution or owner's draw to themselves rather than trying to take up big chunks of money. But hey, I'm gonna auto deposit $1,000 from my business account to my personal account every week. So that way it happens. I'm getting money out of my business. It's not getting stuck in my business. Again, as long as your cash flow plan supports that, I think that's a really important tool to make. And then finally, long-term stability. I think whenever you've got your entity structure set up the correct way and you're monitoring your cash flow, that's when things become stable. So you want to make sure that I'm planning for dips in cash flow over the next quarter. That way, if I do recognize that I'm going to dip below this kind of minimum cash threshold that I've set for myself, I can plan for that. I'm going to delay a payable. I'm going to try to push up a receivable. I might not take an owner's draw this week, whatever it might be, but that's a really helpful tool as well.
Mm. So, Brett, could you have an example of a situation where changing the way an owner paid themselves significantly improved the financial side of their business?
Yeah, absolutely. So, the IRS, let's look at an S corporation again. So we kind of gave the example on the last question about if you were to elect into an S corporation, you could save typically 15 grand or more in taxes. That's cold hard cash that you're not sending into the IRS. But another example is when you are an S corporation and the IRS says, hey, you need to pay yourself a payroll. But that doesn't mean you can go pay yourself a $20,000 payroll. They say it needs to be a reasonable compensation. That's basically the only direction the IRS gives you. It needs to be reasonable. Well, what's reasonable? Nobody knows. They'll tell you whenever they're auditing you. So we have a process whereby we calculate a reasonable compensation for our clients. So a perfect example is I had a client. It was a marketing firm owner, and they made about $250,000 a year net. So let's say $1 million in expenses, income, $750,000 in expenses. They made about $250,000 after that. They were paying themselves $240,000 on a W-2. That is a very high number, especially when you consider their earnings were only $250,000. So they're paying themselves $240,000 on a W-2. And I said, why are you paying yourself that much? And they said, well, I was under the impression that I basically had to pay everything out to myself as a salary. And I said, well, by you paying yourself a salary that high, you're paying Social Security tax up to the limit. So you're paying your total Social Security tax up to, I think the cap is this year $170,000, somewhere around there. You're paying Social Security tax on that. And then you're paying Medicare tax, the 2.9%. You're paying that on all those dollars that you're earning. So we did a reasonable compensation interview with them. And I said, hey, based on what you're due, I would readjust, or I would adjust your salary and pay you something more like $85,000 a year. So I went from 240 to 85. So then you take the savings of almost 15.3%. It's a little more complex than this, but about 15% of that difference. So 240 minus 80, what is that? 160,000? 160,000. 15% of that number is how much you save because you're no longer paying payroll taxes on that amount. So again, just huge numbers, $12,000, $13,000 in tax savings by making one small little tweak. We're being compliant. We're following the tax code, doing nothing illegal. It's just being smart.
Right. Wow, that's good stuff.
Yeah.
So to kind of put a nice bow on this conversation here, Brad, what usually changes in the way business owners approach compensation once they start treating the business more strategically, like you mentioned?
So I think business owners, one of the most important ways business owners start paying themselves once we do these studies and they understand is it's just a lot more consistent. So there's a book called Profit First by Mike Michalowicz, and I really like the book for entrepreneurs. And one of the lines he has in his book is he says, we want to talk about eradicating entrepreneurial poverty. So entrepreneurs are really great at their trade or their skill, not so great on the financial side. So they can be good at growing their business and making more money, but they're not good at paying themselves. And so this book talks about kind of feeding this cash monster that's just eating your cash. So once we can put a plan in place for our business owners and say, hey, this is going to be your salary. We're going to pay you $80,000 a year. But then we want to also take an owner's distribution. So you're also going to take an owner's distribution of $1,000 every week. So by forcing that and building it into the cash flow model, that allows owners to finally feel like I'm earning something from what I'm building. And when you make it smaller increments consistently, it allows you to take money out of your business and live your life the way you planned on when you wanted to be an entrepreneur and build the business, rather than trying to take a big chunk of money out every quarter or every 6 months because maybe you had a big windfall and I haven't paid myself since January and I'm going to take a payment. But putting it into your plan, making small incremental payments really allows you to feel the success of your business.
That's good stuff, Brad. I appreciate your time, brother.
I appreciate it. Thanks, Evan.
Good stuff. That's it for today's episode of the Luca Ledger with Brett Arnold. If you'd like to learn more about strategic tax planning, fractional CFO services, or building a stronger financial foundation for your business, visit luca-fs.com. Thank you for listening. Don't forget to subscribe, leave a review, and share this episode with another business owner who could benefit from the conversation. And we'll see you next time.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.